Dr. Jonathan Newman here is the Assistant Professor of Economics and Finance at Byron College. He is an Associated Scholar of the Mises Institute and also author of a fairly new book, The Broken Window. Highly recommend you pick it up. It's a very interesting book, kind of explaining some basic economic concepts. I really liked it. I know you guys will as well. And without any further ado, Dr. Jonathan Newman.
Thanks, Rich. Hey, everybody. Like you said, I'm Jonathan Newman. The topic for my talk tonight is current research trends on Austrian business cycle theory with an eye towards good areas for future research. So I know the people on the server are well read and know a lot about Austrian economics. So I want to talk about something that would hopefully stimulate new research. It's convenient because I've been working on a project with Arcadia Sierra on the same topic, and it will be in a book edited by Per Byland. I think it's called A Modern Guide to Austrian Economics, published by Edward Elgar. So looking forward to that. Should be published sometime this year. So thanks, Rich, and everybody in the server for the opportunity to talk through this project here. First, I'm going to summarize Austrian business cycle theory, but instead of doing that quickly, I'm going to spell it out in a little bit more detail than usual, so that I can address some sticking points and debates that may be interesting to you. And I know you guys can handle it because I've seen your book clubs and libraries and discussion on the server, and hopefully I can stimulate some research that maybe not for the next scholars conference, but maybe the one after next, that's a week from now. Hopefully I can stimulate some good research for that. But after I go through Austrian business cycle theory, I'll list out 4 trends and areas for future research that I think would help us in our understanding and application of Austrian business cycle theory going forward. So let me get started here. Austrian business cycle theory refers to the explanation of economic booms and busts that are set in motion by artificial credit expansion, which is when we have an increase in credit that's not matched by a real postponement of consumption. When credit is expanded beyond savings, entrepreneurs take the new money and they start new projects that can't be completed because the necessary resources aren't there. So that's it in a very small nutshell. The business cycle theory is contrasted with the theory of sustainable growth. In that case, real saving actually does free up resources for entrepreneurs to complete more roundabout production processes. Longer production projects are only feasible if resources have been set aside first. And I've got a little example here with Crusoe. So this is true for Crusoe, who can only create a new fishing net if he first stockpiles enough berries to last him through the stages of production for making a fishing net. So if he has a current level of consumption and he wants to expand production, do something different, the first thing that he has to do to extend production to make something like a fishing net, a capital good, so that he can get some fish out of the water, is the first thing he has to do is he has to set aside resources that will help him last through the structure of production that's longer. So that's just like fundamentally true. But it's also true in an advanced industrial and money using economy like ours, in which entrepreneurs respond to changes in the supply of credit and interest rates to decide which lines of production to pursue. So none of the added layers of complexity between those two economies, Crusoe and our current advanced economy, voids the fundamental logic that saving must precede any sustainable lengthening of production. The logic is just easier to see in Crusoe's situation, which is why we use it when we're teaching, because it's good at teaching the basics. So that's the fundamental problem that we see in business cycles, is that there's this disconnect between the production projects that are pursued and the consumption that is currently being undertaken. In America's Great Depression by Rothbard, he emphasized the general character of booms and busts. So the changes that only happen at the firm or industry level are not business cycles. They're just the mundane business fluctuations that entrepreneurs try to anticipate. If they do anticipate them correctly, they profit. If they don't, then they incur losses, which is why economic calculation is so important for our economy. So the profit and loss mechanism incentivizes profitable economizing production, and it provides reliable information about consumer valuations and the true cost of production. But if that's true, then what disrupts this process in a business cycle such that entrepreneurs in general seem to be making the same kind of errors at the same time? So a good business cycle theory needs to explain what Rothbard called the general cluster of errors. So it seems like something is going on that's different than what we usually see or what we would expect to see due to the economizing nature of the profit and loss mechanism and entrepreneurial economic calculation. But that helps us narrow our search for what can cause a business cycle. It means that we can consider things that permeate the entire economy because the booms and busts are general, they're economy wide. And we can consider things that would cause entrepreneurs to make mistakes in their production plans. So those are the things that we can look for now when we're trying to figure out what causes a business cycle. So money and credit are suspect areas for a few reasons, and I've got five reasons listed here. So the first one is that money permeates the entire economy. It's exchanged for goods and services in virtually all transactions, and all prices are denominated in the same money. So since money is everywhere, it seems like it's a good place to look if we're looking for something that would cause a general business cycle. The second reason is that entrepreneurs use the interest rate, which is revealed in time markets, to discount anticipated cash flows. So that might have something to do with changing production plans. Thirdly, entrepreneurs demand present money in credit markets to start or expand production. So credit is also a limiting factor for the choice of projects that entrepreneurs pursue. Fourth, the supply of credit represents foregone present consumption, so it tells us something about time preference and the availability of resources for production. So that would give us a clue about a potential mismatch between consumption and production. The fifth reason why we should look at money and credit is that it's really suspicious that fiat money and fiduciary media are not regulated by profit and loss. So they're totally different from other goods in the economy. So, or in the case of a gold standard or any sort of sound money regime, the money production is regulated by profit and loss. In the case of fiduciary media with fractional reserve banking, we could say the same thing that the amount of loans that banks extend is not it's not regulated by profit and loss. So this makes them suspect because it seems like the lack of profit and loss would cause them to go haywire relative to the rest of the economy. One thing that we can say about the first suspect area, money, is that changes in the money relation per se cannot explain the cluster of entrepreneurial errors. And this gets at the debate over monetary disequilibrium and whether it can cause a business cycle. The key here is that the malinvestments in the boom involve an intertemporal reshuffling of factors in the stages of production. So there's something going on in the way we're allocating resources intertemporally in the different stages of production. It means that a mere change in money demand or money supply could not explain a systematic rearrangement of production. Changes in money supply and money demand are not necessarily related to changes in time preference or intertemporal resource allocation. The interplay of present money supply and present money demand results in money's present purchasing power. But consumption and investment proportions, however, could stay the same or tip either way with the change in money demand. There's no causal relationship that says that an increase in money demand must be associated with either an increase or decrease in time preference. Now, there's an important caveat here. If the new money enters through credit markets, then there are real effects for economic calculation, for production and consumption decisions, and the integrity of the structure of production. So that's why Austrian business cycle theory points to artificial credit expansion, not monetary disequilibrium, as the cause of an unsustainable boom. It's because there's nothing about changes in money supply and money demand that could bring about the changes in the structure of production like we see with an artificial credit expansion. So now let's talk about the boom period. So the boom period features both malinvestment and overconsumption. Malinvestment is the misallocation of capital into longer term projects that can't be completed. And overconsumption is the increase in consumption and decrease in saving that happens because consumers are overly optimistic about their own income and wealth. The artificially lowering of loan rates would also explain the increase in borrowing to finance consumption. So there's two things happening. There's an increase in the supply of credit, and that there's also a lowering of interest rates or loan rates, to be more precise. And both of those things would explain the malinvestment and overconsumption, even though they happen at the same time and they're related to each other. So the new projects can't be completed due to the lack of resources needed to complete them. What caused the entrepreneurs to start those projects was all fake. The investments and project selections of entrepreneurs are disconnected from the preferences and consumption patterns of consumers. Eventually, this disconnect between production and consumption is realized, and profits turn into losses. So the boom turns into bust. Usually, when the central bank, like our Fed, has a dual mandate to keep prices stable and maintain full employment, if the central bank sees that prices are increasing at an unacceptable rate, they'll allow interest rates to increase with contractionary policy or probably less expansionary policy. But there are other ways that the boom can turn into bust too. So we could talk about that in the Q&A if you'd like. But all of a sudden, producers of capital goods have an unexpected decrease in demand for their output because the easy credit that enabled it was finally restricted. So what was propping up the demand for all those capital goods was the easy credit. Now that it's restricted, there's this unexpected decrease in demand, and now producers, entrepreneurs are scrambling to figure out what to do about this. But before we keep going with what goes on in the bus, it's worth noting that another way that the unsustainable boom could progress is with what Mises called a Krakow boom. And that's when the central bank doubles down on the inflation with even more inflation, preventing the necessary corrections from taking place. The end of that scenario is hyperinflation, and there's a complete breakdown of the structure of production. The money itself is replaced as its value goes to zero, complete chaos. But what usually happens is we have a correction. And when that happens, all of the malinvestments have to stop. All of the capital has to be liquidated. All the workers have to find another job. All factory owners have to find profitable employment for the factory that they own based on real-time preferences and availability of resources. Of course, all of this is easier said than done. It's a really painful process, as most of us have seen. So the economy-wide correction involves laid off workers, capitalists reluctantly accepting low prices to minimize losses. Stock prices for firms collapse as expected firm profitability turns into losses. And entrepreneurs who are hesitant to get started again due to a lack of confidence in their own ability to forecast the market. So that's actually something that Joe Salerno points out in his Reformulation article is the change in psychology that produces all of these secondary effects of the boom bust cycle. So we could talk about the economics, but there's also like the secondary deflation and the changes in market psychology that happen as well that help us explain what we see in history. So that's what happens in the bust. It's worth pointing out that it's a healthy adjustment period. It's where we fix all the mistakes that we made during the boom. It's not something that needs to be stopped or addressed with policy. But as we all know, governments love to step in and they like to try to help. They have an action bias, which means that they're more likely to do something than not do something simply because it looks bad to do nothing. People in government, like politicians and bureaucrats, also have incentives to capitalize on a perceived economic emergency. It's a good opportunity for them to grab power while everybody is scared and there's lots of uncertainty and people are losing their jobs. So it's definitely an opportunity for governments to step in and expand their own uh, size and scope. So they go, but what happens is they get in the way of the necessary adjustments with all kinds of interventions. These interventions usually take the form of propping up the malinvestments and exacerbating the overconsumption. And they do this with more monetary expansion and fiscal stimulus, or they call it stimulus. It's not really, I mean, it's stimulating if you look at numbers, if you look at the level of spending, but it's not really stimulating in terms of actually providing for real sustainable economic growth. So that's whenever they turn the printing presses on during a bust, during a recession, they're just making it worse. They're just propping up the malinvestments. They're just causing people to consume even more. But that's what was causing all the problems during the boom phase anyway. So it's clear that the smoothest recession adjustment process would involve the government just getting out of the way, halting monetary expansion, decreasing taxes, decreasing spending, removing regulatory burdens. And one benefit of that sort of policy is that it would prevent more business cycles from occurring. So that's Austrian business cycle theory in a nutshell. I tried to dwell on things that are sticking points or areas of debate, uh, but that's my best stab at going through the step-by-step process of the business cycle. Now I want to mention some research areas that I think have the most potential. So if you're a young scholar out there, turn the volume up. I think I've got some good ideas for you. The first one is that we definitely need to bring Austrian business cycle theory in line with new banking practices and financial sector developments. We need to settle or at least address the debate over endogenous money and exogenous money. Thankfully, for Austrian business cycle theory, we have the artificial credit expansion either way. So it's not like the whole theory is at risk of being tossed. But we do need to be careful about who or what we blame for the artificial credit expansion. If central banks are more passive, meaning that they supply reserves based on commercial banks' demands for reserves based on the level of deposits, then it's fractional reserve banking, not monetary policy, that gets most of the blame. But there's also implications here for like the the extent of the malinvestment and the extent of the overconsumption that occur, for example, when we see a lowering of the federal funds rate. If it's true that money is endogenous, or at least one way to think about it is being endogenous, then it means that we can't always say that there's going to be a, a business cycle whenever we see a lowering of the federal funds rate, at least not to the extent that we would if we had a purely exogenous view of money creation. By exogenous, I mean coming from the central bank. So the central bank expands reserves, and that forms the basis for commercial banks to then extend more loans to other people, and so deposits are multiplied in that way. That's the exogenous view. Is the one the exogenous view is the one that you would see in most money and banking textbooks. It's really the debate is pretty young. So if you see this debate in your money and banking textbook, it means it's been written or edited very recently. But like I said, Austrian business cycle theory survives it both ways. Mises and Rothbard and even Hayek pointed out that fractional reserve banking is the primary way that credit is expanded, starting an artificial boom. Rothbard did talk a lot about the effect of central banks expanding reserves, which could increase bank lending. But if you look at Man Economy and State, and I did this, just yesterday or 2 days ago, he starts his discussion of business cycles with bank credit being expanded, not the actions of a central bank, which is interesting. So back in the back part of Man, Economy, and State, when he is talking through the economic theory of business cycles, he starts it with a bank credit expansion, that's in line with the endogenous view. So like I said, it's not like Austrian business cycle theory is at risk of being wrong. It just means that we have to be careful about the way we scribe booms being started. That's all I'm saying here. But other research topics in the same area are shadow banking, new monetary policy tools. Like we had this interest on excess reserves. George Selgin has a book all about this new monetary policy regime that he calls a floor system. If you're interested in shadow banking, then you should look at the work of my co-author Arkadiusz Sieran. Has a paper in the Quarterly Journal of Austrian Economics on shadow banking. And also, there's a new text by Robert Murphy on understanding money mechanics, and I'm really excited to be using that in my money and banking class this semester. And he goes through all of these debates that I've just mentioned about endogenous money, exogenous money, new monetary policy tools, uh, all that sort of stuff. But you might also be interested in checking out the mainstream literature on endogenous money if you really want to be up on that debate. It's a pretty interesting debate, I would say. So that's area number one that I would recommend scholars looking at if they want to advance Austrian business cycle theory, is to look at new banking practices and financial sector developments. The second one is the rational expectations critique. So this is a cool theme in recent literature. The rational expectations critique basically asks, why don't entrepreneurs learn? Why do they take the new loans from a credit expansion when they should know better? They should know that a bust will come if the money is taken to start new projects. So why, if all of a sudden entrepreneurs are incurring losses because of the business cycle, then why don't they learn from this process? Why don't they just see that the Fed is artificially expanding credit, or I should say, in light of my previous topic, why don't they see that banks are expanding credit and it's not backed by real savings, and decide to not take the bait? Why do they go along with this? So that's the essence of the rational expectations critique. Um, So it's a good question, and you've probably heard Austrian business cycle theory described as entrepreneurs getting tricked into thinking that there are enough resources to complete all the new projects. But when you say it like that, you're probably giving entrepreneurs more of a bird's eye view of the economy than they have. All they really need to know is the prices of factors of production, and they need to be able to make a guess about how much people will pay for the output. But still, we have this question about why entrepreneurs get tricked all the time in business cycles, when usually they're good about thinking ahead. Like in the first part of my talk, I talked about the benefit of economic calculation and entrepreneurs being incentivized to predict the mundane business fluctuations. So there are a few responses to this critique. One is that even entrepreneurs who are well versed in Austrian economics and its business cycle theory, they're skeptical of fiat money and bank credit creation, and who are on the lookout for impending financial crises, even entrepreneurs like that would still find it profitable to participate in the unsustainable boom is with the hope of exiting at the top. So there's still profits to be had, even if you know it will end in a bust. So it's not like knowing Austrian business cycle theory negates the fact that you can earn profits during the boom period. You can know full well that it's an artificial boom and that it's all going to be a bust one day, but that doesn't take away the fact that you could still participate in the boom, and try to time the bust so that you're not left holding the hot potato, so to speak. So that's one response. Another response is that economic calculation is distorted for everyone, which means that even the most cautious investor will make mistakes. A third response is that the set of people who would need to learn these lessons is continually changing as entrepreneurs enter and exit the market. And credit expansion itself induces marginal individuals to decide to become entrepreneurs. So Lucas Engelhardt has a great article on this in the QJ. Oh, I can't remember the full title. Austrian business cycle theory and declining or decreasing entrepreneurial quality, something like that. Finally, another response to the critique is that even knowledge of Austrian business cycle theory does not give you detailed information about how a particular cycle will play out. There's all sorts of price changes and complex rearrangements of production. There's the precise timing of it, and none of this is given by economic theory. And if it was, I'd be much wealthier than I am. So, one thing I'd add that I haven't seen in the literature is that it could be that there's not as much tricking as the rational expectations people think we need to account for. Uh, we've already talked about how governments typically respond to the bust with monetary and fiscal stimulus. So somebody with rational expectations might participate in the boom with the expectation that if and when the bust comes, the government will bail them out or something like that. All of the big financial institutions seem to be operating under that assumption anyway, in the lead up to the 2007 2008 financial crisis. So they might have known perfectly well that there was a bust coming, but they made all their decisions anyway. It just seems to me that 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 line of thinking is missing from this literature. So maybe there's something there. Continuing on, another trend in the literature and area of promising future research is emphasizing the real aspects of business cycles, including the real resource constraint, the nature of the malinvestment, overconsumption, and capital consumption during the boom, and also Cantillon effects. One paper I'll mention here is by Edward Brown and David Howden on the rise and fall of the subsistence fund. I think it's 2012. Which, if you read Mises's first exposition of Austrian business cycle theory and theory of money and credit, it's all about how the production is lengthened beyond what the subsistence fund can sustain. The subsistence fund is an old idea in economics that refers to the consumption goods that are used to sustain a population between harvest seasons. So, to get from one year to the next, you need a stock of food to last you through the winter, basically. I actually did a part of my dissertation on the history of thought of the subsistence fund under Joe Salerno. So I'm actually pretty interested in seeing if this concept can gain some traction and be resurrected. We can apply it to Austrian business cycle theory because we need more consumption goods to sustain us through a longer production process, and that's describing the subsistence fund. So the reason this is a good research topic today, even though it's an old idea, it goes all the way back to early 1800s. The reason it's a good research topic today is because in a complex economy like our own, it's difficult to say what exactly is or where the subsistence fund is. So like what exactly is it? And the reason why is because we have a bunch of simultaneous production projects that are spitting out consumption goods all the time. So we don't really have a fund, like we don't have like a silo full of corn that will last us through the winter. We have a bunch of different production projects going on at the same time, and so it's more of like there's both a stock and a flow element to it, as Brown and Howden talk about in their paper. So, and we're not as beholden to the seasons like agrarian economies were back in the day. Another great paper on the real aspects of business cycles is Salerno's reformulation paper, uh, and this defends the Misesian version of the business cycle theory against the I can't pronounce it, Haberlerian hydraulic sectoral shift version. And that was used as a straw man for people like Paul Krugman and even Tyler Cowen after the financial crisis. They were trying to say that Austrian business cycle theory doesn't explain the coordination between consumption and investment. They were basically saying that it doesn't make sense. Why do we have to have a painful bust if we can just move all the demand and the spending from the higher order stages up to the lower order stages or earlier, or excuse me, later in the structure of production? Then why does it have to be a painful process? Like, why can't we just switch the demand and the spending around? And so Salerno has a great refutation of that, which deals with the fact that we make real malinvestments. We invest, we make specific capital goods that have to be totally liquidated, that are inappropriate for the structured production that would exist in an unhampered market. He also emphasizes the overconsumption that happens. So we actually don't have the same level of capital accumulation. We don't have the same level of capital because of the boom bust period. So we actually eat into our capital stock. All right, getting low on time here. The last area I'll mention involves international spillover of the business cycle. So, how does a credit expansion in one country affect another country? It's a very intriguing question. If you're interested in this, you should look at Kachanowski's 2014 paper on fiat currencies and open economies. Carmen Dorobat, she did her dissertation under Guido Holzmann and looked at international Cantillon effects in business cycles, and it's really good. Walter Block, Jeffrey Herbener, and Lucas Engelhardt have, I think it's a 2019 paper on how countries with sound money can sort of insulate themselves from the harms caused by credit expansions in other countries. So that actually brings up an interesting research question about how central banks around the world respond to each other and what the implications of that are for business cycles globally. So one thought I have in my mind, I haven't really done a lot of thinking about. This is all very new. This is fresh off of my brain. Uh, I wonder if you could describe the relationships between central banks around the world in a game theoretical sense, such that you could come up with an optimal monetary policy, given the monetary regime that exists and banking regime that exists there, come up with an optimal response to what another country is doing, so that if you see another country expanding credit and you don't want that to infect your country, you don't want to have the business cycle in your country, but you have trade with that country, then what can you do as the monetary policy authority in the country that's not expanding credit to prevent the business cycle from happening in your country? It's a very interesting question. So, I don't know if there actually is a way that you can describe that in a game theoretical way, but it sounds like an interesting question to me. Okay, that's all I have. Thanks everybody for letting me talk about this project, and I look forward to discussing it with you in the chat.
Thank you very much. We have a few questions here for you. So the first question here comes from ChessCheck01, and they ask, "Do you think that a Krakow boom is coming?"
Oh, I have no idea. Like I said, you don't get all of the you don't get all the details from economic theory. I'm not able to make predictions like that. Uh, and also, like I said, we're in a totally different monetary policy regime, and banking practices are different. So even though we've seen a huge expansion of the money supply, and we've seen a huge expansion of bank reserves, I am not prepared to make predictions about what's going to happen in the future. I will say that I'm more pessimistic than optimistic in terms of in terms of macroeconomics over the near future. Um, Simply because I see other indicators around the economy that makes it look like we're we're having trouble bouncing back from this from the COVID pandemic and all of the stimulus that happened there. It seems like you can't print your way back to supply chains working like they should. You can't use government to just make the economy go back to like some sort of healthy growth path. So I'm pessimistic, but I don't know if I would say that I'm pessimistic enough to say that we're going to have a Krakow boom in the next 5 years. But I could also be totally wrong. Who knows?
Next question here comes from Jacob PD. He asks, I plan to pursue a PhD in finance, primarily doing research on portfolio management and investing strategies across the business cycle. What characteristics in the Austrian story of the business cycle can help investors in this area?
Great question. I I would say so. First of all, like one temptation is to try to formalize it and mathematize it, and I've seen people try to do that so that they can come up with precise predictions about what assets what would the assets value really be if we didn't have the credit expansion, or what is the optimal way to time the bust of the recession. But how do you know that we're at a top? I'm not sure that we at least what I've seen, I'm not sure that we have good answers to those sorts of questions. But I do know that there is a lack of financial literature or financial talk about Austrian business cycle theory. David Howden has, I think it's close to the size of a full textbook. He's got all of his notes that he has when he teaches. And if you can get your hands on that, he talks a lot about the uh, changes in risk and how that changes asset valuations over the course of the business cycle. But other than that, I don't really have any other pointers besides that.
Next question here comes from Dabchick. He asked, are business cycles characterized by the monetary aspect or the fact that they seem to be a repetitive pattern?
Hmm. I don't know if I understand the question. Uh, so can you repeat it? What is it again?
Yes, are business cycles characterized by the monetary aspect or by the fact that they seem to be a repetitive pattern?
So if by repetitive pattern, Dabchick means that we see one cycle after another, um, then well, I don't really, I guess I don't really understand what that means. I would just say that the reason why we see cycle after cycle is because governments respond in the same sort of way. They respond to one recession with even more monetary stimulus. So they set the stage, they set in motion a brand new business cycle over and over. I uh, Regarding the monetary side, I think that all monetary calculation becomes bunk. Like it's all falsified during the business cycle. So it's really hard to say how prices and the purchasing power of money will change through the cycle as well. I hope I'm somehow addressing the question.
Right, next question here comes from Radioactive Beans. He asked, what do you think is the exact role of the subsistence fund in the context of a complex money based economy?
Oh, that was my question to all of you guys. So that's what I was trying to say. Somebody needs to figure that out. So back in the old day, the subsistence fund referred to the fact that we need a stock of consumption goods to last us through winter. So in an agrarian society, we need some goods set aside so that we can survive from one year to the next. But you can think about that as related to Austrian business cycle theory, that we need, well, in essence, what we need is more consumption goods. The problem is a lack of consumption goods. The production plans of entrepreneurs do not match the actual amount of consumption goods that we have and will be able to produce through the changed structure of production. So there's this altered structure of production, and the problem is not a lack of capital, because all lack of capital is we don't have the ability to make those capital goods. And the ability to make those capital goods is you need to pay laborers, and those laborers need to go out and buy consumption goods. So it's all about a mismatch between the consumption goods and the production plans. I think that if we take a look back in the history of economic thought, we might find something useful in our in terms of being able to explain what causes the inevitability of the bust in the business cycle by looking at the subsistence fund literature.
Next question here comes from Vito. He asked, "Are you aware of the Spanish economist, I'm probably going to butcher this name, but Juan Ramos' work on attempting to reformulate Austrian monetary and banking theory and focusing on maturity mismatching instead of credit expansion in regards to the cause of business cycle theories? And if you are familiar, what are your thoughts on it?"
I'm not familiar with that. I'm sorry.
All right, next question here
Oh,
comes from Dave.
but I can say that there is something to be said about the maturity mismatching on bank balance sheets in the business cycle. So what happens is they have this immediate liability in the form of their deposits. So depositors they think that they own all of this money that they can spend, but banks they also on the asset side they have all these loans, or in the case of modern banking practices that I've been reading about lately, they have all these securities that they sell to other financial institutions that are basically packaged up loans. So they have long dated assets and short dated liabilities, and so there's a maturity mismatch that's on bank balance sheets that is what causes, or at least it's a coordinate with the credit expansion that happens that causes entrepreneurs to make all these production plans that can't be completed. But I haven't read his book. I'm not sure if that's what he means by maturity mismatching. But thank you for giving me some recommended reading.
Next question here comes from David Brady. He asked, "Do you think that Austrian business cycle theory accounts for economic stimulus like the railroad investments of the mid to late 1800s and explains the busts and the panics after the death of the second bank in the United States? How does one account for those smaller busts without a large central bank being present in the economy?"
Oh, great question. So even though we didn't have a, central bank before, or we didn't have the Federal Reserve before 1913, but we had a few, short-lived national banks in the United States. But even when we didn't have those, we still had business cycles. And Rothbard has some historical work in the same time period with the Panic of 1819. And there's some other historical work by Austrians that showed that what was happening is that it was the fractional reserve banking was causing the credit expansions. So like I said in the main part of my talk, we can have a credit expansion without a monetary policy authority. It doesn't require a central bank deciding to increase reserves and then commercial banks use that expanded set of reserves to then make new loans. That doesn't have to be. In fact, that's probably not the best way to describe how credit is expanded today. It's probably better to say that there's a given level of reserves that banks want to keep based on how much they think depositors are going to spend, and then they have a separate question that they ask about the demand for loans and also the credit worthiness of potential borrowers, and also the bank's own capital that's allowing them to make decisions about how much lending that they do. So there's still we can still have a mismatch, but it's not necessarily based on starting with the action of a central bank or some other monetary policy authority um, that kickstarts it. We have an explanation for business cycles that works either way. It works with an expansion of reserves by the central bank or with expansion of credit in a fractional reserve banking system.
All right, and the last question here actually comes from myself. And my question is, do you think that Austrian business cycles theory, broadly speaking, has gained more respect in the aftermath of the 2008 financial crisis? As it seems to me that the 2008 entire fiasco seems to be a very visible representation of the entire Austrian story of their business cycle.
Oh man, I wish I had a PowerPoint for this question because I just put in the paper that I'm working on with Arkadiusz Sierran. I just put a chart in there that shows the Google research trends for Austrian business cycle theory. So I encourage you to go look that up separately. And if you look at it, it's like zero basically in 2000. Here, I'm gonna pull it up. I'll just say it verbally. It's like zero around 2006 or 2004, 2005. Doesn't even show up. But then in 2006, it goes up to it's indexed. It goes up to 30, and by 2008, it's up to 60. By 2009, I've got it indexed up to 100. So there's a huge surge in interest once people start to realize that there's this financial crisis going on, and the Austrian story seems to explain it so well. And it sort of flutters down from there. But the point is, there was a huge increase in interest in Austrian business cycle theory because of the most recent crisis and recession. And I think the reason why is because, I mean, it had the very best explanation for what was going on. I mean, I'm of the school of thought that says that business cycles are only caused by credit expansion. The only sort of business cycle is an Austrian business cycle. Is an Austrian business cycle. There's not another sort of business cycle. I think if you see other fluctuations, that's the mundane business fluctuations that Rothbard's talking about at the beginning of America's Great Depression. But it seems like this most recent financial crisis and the boom bust there in the housing bubble, it it matches up so perfectly with the Austrian story that it caused a lot of people to take an interest in it. And just speaking personally here, it gave Ron Paul a something to talk about when he was campaigning for president, and it gave people like Tom Woods something to write about. And so you had young college students like myself who I didn't really know what I wanted to do, but then I saw this recession or this financial crisis happening, and I wanted an explanation. And it seems like this guy Ron Paul and Tom Woods in his book Meltdown, they've got a pretty good explanation for it. It seems to make sense to me. And so now here I am today, giving a talk on Austrian business cycle theory at the Discord servers. So yeah, I think that financial crisis did a lot for educating the masses, indirectly educating the masses on business cycle theory.
All right. Well, thank you, Dr. Newman, very much for being here with us tonight. So, in
Thanks for having
closing,
me.
do you have anything to plug or places where people can follow you at?
Oh, yeah. So I'm on Twitter. My handle is Newman J underscore R. I think that's it. Yeah. So you can find me there. And I've got a few writings. I don't write as much for Mises.org, but you can find stuff that I've written at Mises.org. And yeah, thanks for having me.